Good morning, trades. Obviously, we've got the CPI number in the session ahead. It's going to be the marquee event risk, and obviously volatility could really come out depending on the outcome here. You go into some more sort of trends, looking at shelters and various factors within that core goods and services. But generally speaking, I think the headline number is what we're going to be keying off initially. So what's expected? If we have a look at it on a month-on-month clip, the headline inflation is expected to be up 20 basis points, core expected to be up 40 basis points. That takes us to an 8.1% clip on year headline inflation and 6.5% for core. If you look at the distribution of outcomes from economists, the sort of top end, the most hawkish, is looking for 6.7% year on year, down to 6.4%. So again, we can sort of devise a little bit of a playbook around that. In terms of the form guide, of the last 12 core CPI numbers we've been seeing, 8 have beaten expectations or come out higher than expectations, should we say. 2 have been in line and 2 have missed the downside. Of those 8 that have come out topside relative to consensus, in the 30 minutes after that, the dollar has rallied by an average of sort of 0.4%, 40 basis points. If we have a look at the expectations from various Fed, nowcast models, the Cleveland Fed nowcast model is pricing inflation at headline at 8.2% and 6.6% for core. We've got CPI fixings markets running at 8.1% for the headline number there as well, so we can deduce an understanding about that, where the balance of risk lies. Rates pricing 73 basis points for the 2nd of November meeting. Hard to see that changing too much. We've got 57 basis points being priced for the 14th of December meeting. Where you could see some movement, and I think could be quite influential on markets, is the terminal pricing, which we've got at 465 at the moment. So depending what happens there could impact the dollar. 5-year real rates are sort of stuck between 2 and 1.5%. And again, where that goes could really influence markets. FX volatility is pretty high. You've certainly seen that in Antipodeans, in Aussie and Kiwi 1-week vols, and you've got high levels in cable and euro dollar as well, but they're not sort of extremes by any means. Dollar positioning is long, there's no doubt about that. You've seen that in the trend, but if you look at CFTC data, investment bank flow, they're not at extremes either. CTA is obviously max long in that situation. So how does this go down? Well, I think if we see core inflation at 6.6% or above, I think you're going to see some strong risk aversion coming in markets. If we were to see headline inflation below 8.1% and core below 6.3%, I think we could see some clear relief given how markets are positioned.